Hi, welcome to Watch Your Six. I'm Jason Edwards. Great to have you back. We had a really good podcast last week. We hope you maybe tuned into it and listened to it. If not, again, recommend that you go to our podcast. We're on Spotify, Apple iTunes, or wherever you get your podcasts. It is under Watch Your Six, and you'll see a picture of myself as well as the podcast lingo. So we're looking forward to seeing you there. Our last post, we got a tremendous amount of responses to when we were talking about investments. And more specific, we were talking about how sectors can be utilized to help you determine market trends. And that's fancy words for what's going to happen next. Well, most analysts will use different tools. And as we mentioned, sectors are a good way to determine where types of the economy might expand. And that in turn tells you where to invest. So I thought today would be good to help give you some more information on sectors. And I wanted to start off with telling you how many sectors there are. Many people don't realize that there are multiple sectors in the investments world, and it actually comes out to about 11 different sectors. Those 11 sectors are energy, materials, consumer staple, consumer spending, or consumer discretionary they call it, industrials, healthcare, financials, information technology, communication services, and utilities. Now, when you think about those different sectors, those are all different branches, right? Branches of industry that can then help you determine what? Well, investments. Now, why is knowing the sectors so critical? Well, there are really three things that you have to realize when it comes to knowing sectors and why it helps your benefit. First, categorization. What does that mean? Well, if companies or businesses are separated in particular sectors, then you can determine that business model and how that business model is going to flourish or possibly dry up in an economic environment, right? So if we see an environment where utilities has become very, very successful because now there's a lot of infrastructure build out, or maybe there's a lot of use for energy. Energy is a big need right now. We know that when it comes to the expansion of AI. Those sectors then would help you look at what businesses fit into those industries or what businesses fit into those categories. And by categorizing, it makes it simpler. You're able to look at, okay, here's investments that deal with, for example, consumer discretionary. Here's investments that deal with consumer staple. Here's investments or companies that deal with healthcare. And then you can start to really see the playing cards on your table and then determine what of these areas or what of these business models will thrive in the current economic environment. And that's critical. A lot of times people don't realize, how can I simplify my investments? Now, that categorization helps lead you to the next investment trick. And it's not really a trick, it's a tried and true model, but it's called portfolio diversification. What does that mean? Well, that means your investments are invested in different sectors. And by having them in different sectors, you theoretically can avoid overexposure to one area of the economy. So let me say that again. By being diversified, and now you've categorized and you have these 11 categories, and you're looking at the 11 categories, and you're looking at whatever financial tool you use, online resources, research, whatever it is, and you see, well, this model or this particular area is about to do really well with maybe governmental supplements, maybe private sector investments. Now I look at diversifying my portfolio. How many of these 11 sectors am I in? Am I overexposed maybe in one sector and underexposed in another? Therefore giving the ability or the propensity of me maybe taking a hit because I'm too heavy in one area. So knowing these little things, again, knowing our 11 sectors, categorizing what those 11 sectors are and how they match up with certain businesses, when you're looking at a business to invest in, which sector maybe does it fall into, really helps you look at the ability for your portfolio to be structured. Now, here's the third thing. This is really critical. When you're looking at an investment, let's say you're looking at a stock or you're looking at an ETF, by having a sector, you have what we call a benchmark. So when you look at a sector, industrials, or you look at a sector like consumer staples, well, they all have their benchmarks. Those sectors have, their layer, what that industry is doing currently. And you look at a mutual fund, or you look at an ETF, or you look at a stock position. Now you can determine, how does it compare? What's the performance look like against that sector? So if I'm looking to invest in energy and I've got a mutual fund that is dramatically underperforming in that sector, that category, would I want to invest in that? Maybe not. But again, we recommend you talk to your investment professional and get guidance that fits you. But that's an illustration of how those sectors help you with what we call performance analysis. Looking at your portfolio. And you'll see that a lot with mutual funds, particularly in some ETFs. Towards the bottom on the performance section, you'll see an area where they'll say, here's how it did. And it'll say on its benchmark, it's 15, or on its benchmark, it's 10, or on its benchmark, it's 100. That means it's performing at a certain level as it relates to that baseline or that benchmark. So again, knowing our 11 sectors helps us to look at it from 3 different perspectives. We discussed that: categorization, portfolio diversification, and then portfolio performance. So do your math, do your research, get your numbers in place, and it's a very simple model that can sort of help you realize what's the best way to structure my portfolio. Obviously, there's a lot more to it, but we thought this is a good maybe 36,000 foot view of exactly what you could start with. And even it's as simple as writing on a sheet of paper your 11 sectors that we shared with you. What's my portfolio? Which one of those does it look like it falls into? Oh, wow, I'm overexposed in one area. You might be really surprised at what's going on in your portfolio, and also help you correlate, well, why does my portfolio seem to lag behind the market if it does well, or when the market corrects, I seem to take a beating. These are critical parts to making sure you're doing better. So we hope that works. Again, this is part of the process of watching your 6. These are things that people usually don't think about. Now, another topic that we really think is critical to financial security is what we call estate planning. And there are really 4 pillars of estate planning. A sound financial advice has to have some kind of estate structure. You can't start building wealth and have nothing in place that protects you and your heirs. So the first thing I recommend you do is create a cheat sheet. Now, this is not a legal document, but you should create a document where you've written down where everything is. Safety deposits here, the life insurance is in the file cabinet on the second drawer. I have 4 IRAs. Write down your cheat sheet and keep it in a safe place. Make sure that a member of your family or whoever you're going to be responsible knows where it is in the event, God forbid, something were to happen to you and it was unexpected. But that cheat sheet is critical. I can't tell you how many times clients have come in our office with large estates or large piles of paperwork. They've just lost a loved one, which is traumatic in itself. And now we're having to decipher sticky notes and decipher all this other paperwork. And it makes it challenging. And unfortunately, what happens a lot of times is these assets get left to the states and they become part of the government. They absorb it because the heir doesn't even know it existed. So remember, first and foremost, get your cheat sheet. Now, second, living will. Why is that critical? Well, you need to have a document that speaks for you for why you're alive. Many living wills have medical directives in it. Many living wills have other instructions in the event that you are incapacitated. So that is critical that you have some type of living will in place and you have it very, very well documented, and it articulates to your satisfaction what you think should happen in the event you can't speak for yourself, but you're still here. Third thing is what we call a trust. You should get a trust. Many people don't understand the difference between a will and a trust. Trust is very simply a document that speaks for you. All of your assets should be owned or inside that trust, or should have a beneficiary designated as the trust, because that is an easier way for you to control the assets, to ensure that those assets are going to be dispersed in the way you want, and to ensure that there's some kind of continuation of those assets. So again, we've got the cheat sheet, we've got the living will, and then we have the trust. Now, there are 2 types of trust. There are revocable and irrevocable, and depending on your state situation and whoever your financial planning team is, those are different considerations. One allows you access, one excludes you access. So we'll get into that a little bit more at a later date, but those are 3 continual pillars that need to be in place. And the 4th pillar, which is probably one of the most critical, is a durable power of attorney. Many people do not have documentation that allows their daughter, their son, their wife, their husband to handle accounts if they are incapacitated. Many times people will get injured and they survive, but there's months and years of recovery. Now imagine your checking account being froze for a year. Or imagine access to, getting information, medical information or medical treatments, or getting other type of financial support, but you can't speak and you're not available to fill out any documents. What happens? Well, you lose that opportunity. So getting a durable power of attorney is phenomenal. Anybody, no matter the age, should have one on file with someone they love and trust. That allows that document and that individual to now speak on your behalf and to execute on your behalf and do what's in the best wishes of you. So these are 4 simple but very sound pillars to making sure you have financial competency when it comes to building wealth. And wealth is relative. If I've got 1 car and 1 dog, I still want those to be taken care of if something happens to me. So I got to make sure I have documentation to handle that. If I've got a large business or estate, I want to ensure that those assets get passed on to the people I love, right? So use those documents, make sure that you have that structure, and then you may make it more elaborate. Obviously, those individuals that are listening, we know there's family limited liability trusts, there's all types of trust or revocable trusts, there's offshore trust or credit trust. I mean, the list goes on. And those are resources that can be used for tax planning, for reduction in estate taxes, and so forth. But again, everybody in the sound of my voice or the visual of my picture should think about those 4 pillars and make sure you have those on play. Now, another thing that's come up recently in our conversation is IRAs. IRAs stand for Individual Retirement Account. And many people don't realize, they get excited to hear about a Roth IRA and they go, I'd love to have a Roth IRA. Unfortunately, because of certain limits, many people make too much money to qualify for a Roth IRA. Now, why is a Roth IRA so attractive to some people? Well, 1, the money is tax sheltered while it's in there. So now you've got an account that's growing in wealth. And every year you're not getting hit with taxes, which we've discussed in previous shows, makes it grow faster. And the second benefit is at the time you just start to use the asset at retirement, that money is tax free. Now, I have a different opinion. I don't really know, and I'm not going to say what the future holds when it comes to our government's policy on spending and how they interact with the accounts we have. But the current law says that that asset would be tax-free. So that sounds really good on paper. But here's the catch. If you make too much money, in many cases, you can't even qualify to use a Roth. You can't qualify to put money in a Roth. So there is a really nice and unique tactic, which is legal, called a backdoor conversion. The backdoor conversion allows you to circumvent that limit. And it's a very simplistic approach to helping people that are still making good money access Roth IRAs. What you simply do is you create a traditional IRA in your name, and then in that same year, you move those funds over to the Roth IRA side. You pay taxes on the money that you put in the IRA, so that's reported as income, and now it becomes a Roth IRA. Now, a couple of little nuances, things you can do. One thing I'll tell you not to do is if you're doing a backdoor conversion and you put money in that traditional IRA, don't invest it, leave it in cash. Why? Well, there's no capital gain when you convert it. So you get taxed, that money goes into that account, it's not deduction, so it's considered income, but the account didn't gain any access, so it didn't gain any kind of growth to resources. So now what happens is when you switch it, there is no capital gain tax because you're simply moving it over. What the mistake many people do is they put money in traditional IRA and 3 or 4, 5, 6, 7, 8 years go by and they've invested it. Now that account has made capital gains every year. And when they do the conversion, now they've got to pay taxes on all of those gains. So a good way to augment that or offset that or avoid that is simply open an IRA in cash and in the same year convert it over to a Roth IRA. Now you've completed what we call a backdoor conversion, and now you have a Roth IRA. And from there, you can start investing it. So I'm sure you have investment firms or companies that you work with, hopefully, and it should be foreign to them. If it is foreign to them, then that is an indication you might want to start working with a different company, because the backdoor conversion is a great tool to help you minimize taxes while it grows and get a tax-free income source at a later date. But once again, this is why we say it's so critical to have a team. In the last 15 minutes, we've discussed things like investment sectors, we've discussed estate and will issues, and we've discussed tax-deductible investment accounts. That's a lot to absorb. And if you're an individual, it sounds really good and really simple at first, but then you go on your daily life and forget about 50% of what we discussed. And remember, the devil is in the details. If you do a documentation or a conversion wrong, it can create a tax penalty, tax liability. If you're not really clear on what sectors you're investing in, that could create issues with your portfolio. And the last one is if you don't really think about ways to protect your assets, it could result in your accounts becoming absorbed by the government or the state. So getting a team, you're welcome to contact our firm. Talk to us on Watch Your Six. Hit us a DM or a message, and we'd love to give you some access. Go to our website, www.efs-advisors.com or Edwards Financial Services. But you want to get a team around you that's helping you address these things and thinking about the nuances and the specific details that maybe you've overlooked. We always recommend, remember, you either fail to plan or plan to fail. So we want to make sure that you're protected and that you're going to be taken care of. And we just want to highlight that in a week or so, we're going to have some electronic books that we're going to be sending out to some of our listeners and viewers. So those will be complimentary. I think you'll find them really beneficial. Okay, let's go to Grady. He's got some DMs for us. And again, always, guys, we recommend you DM us on Instagram, or you're welcome to email us at our webpage, jasonedwards.com, or go to our Watch Your Six webpage and let us know what you think. Go ahead, Gary, what you got?
Yeah, man, Jason's a workaholic. He's always has those eyes on those DMs, guys. If you send them in, we're definitely going to take a look at them. We can't respond to everything all the time, but we try our best to make sure that we read all those. First one, Jason, it says, Jason, I've been watching your podcast a lot. Are you anti-savings account?
So that's a great question. So I'm not anti-saving, I'm anti-losing money. So remember what a savings account is for. Unfortunately, in America, we've made it into a slush fund. Savings accounts are designed for emergencies. An emergency such as I lost my job. That's really what it's for. Or something happened where I have a financial catastrophe, the roof caved in. So I never recommend leaving more than that money in a bank account, because anything sitting in a cash account gets hit by inflation. Remember, in the last 3 years, we've had double-digit inflation. So you, on average, if your bank account was full of cash, it on average lost 8 to 10% a year. Now, you don't see that because you look at your bank account, it still says $1,000. That's great. Look, I got $1,000, and the buddy over there investing, he's down to 800, so he lost 200. Yeah, but the buddy that's investing, if he leaves his asset alone, that'll come back. Your account will never change. So what your dollar bought 3 years ago and what your dollar buys today isn't the same. So you didn't even keep up with inflation. So what I'm against is keeping too much in savings. We always recommend 6 to 8 months of emergency funds. So that means you sit down with a pen and paper and you write, what's my mortgage? What's my rent? What's my car note? What's my gas? What's my utilities? What's my cell phone? What's my car rental? What's my car insurance? What's my groceries? What's my all those different components. And you come up with a number. And whatever that number is, we call them hard costs. You magnify or multiply that by 6 or by 8. That's what should be sitting in your savings, no more. The rest needs to be in play. And I'll go one step further, and people hate this, but I also don't like high yield savings or CDs, because what I'm doing is I'm creating a tax liability. You understand that? If you get that measly 3% at the end of the year, even if you didn't need it, guess what happens? You get a 1099 from the bank. The bank reports as income. Now you've paid taxes on 3% of your money for no reason. You didn't need it because you just left it there because you weren't using it anyway. So minimize the effect of inflation, minimize the effect of losses on your accounts by having too much in your savings account. But I think a savings account is critical, but it has to be designed for a specific role. So hopefully that answered your question.
Next one, Jason. My son is a delivery driver, looks like for a popular delivery service. Could I get him a new car as a business expense? His car now is kind of run down, and I would be happy to if I could write some of it off.
So that's a good question, and depends on a number of different things. One, you can't just buy a vehicle and give it somebody as a business expense unless you own a business. So you have to determine, do I own a business? Am I a W-2 employee or do I own my own company? Now, if you own your own company and maybe it's an LLC or an S Corp or C Corp, there is the possibility that you could buy a vehicle for the company and then make that a deduction for the company. But then it has to be very specific on what it's used for and who it goes to. You couldn't gift it to somebody. Now, if your son worked for your company, then there would be a possibility of that. I also like the lease concept. And the reason with a lease, and again, it depends on your taxes, and we always recommend you talk to your financial team or your CPA. With a lease, you get to deduct the whole payment. You get to deduct car, the tires, the service, the wear. All that gets a deduction for the organization because leases are looked as assets being rented, so to speak, by an organization. So there are a lot of deductions, but in your case, I think you want to be careful and you want to make sure, A, am I an employer or an employee, and B, does my son work for him? So you may not be able to do that, but if you wanted more information, feel free to email us and we can get some more clarity and ask those questions and get some answers for you. But good concept. What's the next one you got, Grady?
Last one, Ehab asks, hey Jason, where can I go to get some easy financial tips?
So it's ironic you mentioned that. If you listen to the podcast we talked about earlier, we're going to have an ebook coming out pretty soon. It's going to be complimentary to our listeners. We're going to have you click on the site, DM us for it, and we'll get everybody a copy. Those are a great resource. Another thing you can do is go to some of the staple financial journals. Wall Street Journal is a good journal I utilize a lot. You've got Forbes and other areas. But really, to be frank, that's where you have to do your research on the teams that you have. I mean, you can go online and find good information about being a doctor. You can go online and find good information with, AI and how to be a lawyer and handle a case. But would you really handle your own case using AI? Would you handle your own medical advice using AI? Of course you wouldn't. So you don't really want to do that with financials. You want to make sure that you've got a team. I would probably spend some time maybe using our tips to research the financial planner in your area that you want to work with. See if they match up, see if some of that information makes sense. And that's probably what I would consider the best way to approach it, because that's going to give you the sound advice, because at some point you run out of bandwidth. Remember, your life is consumed with your family, your personal expenses, your personal health, your goals, your business. Now you're going to throw something that takes many people 4 to 5 years to even comprehend into your life, and now you've got to manage. Unfortunately, with the internet, it's come across as it's very simple. I can make millions being a day trader, and we've discussed that in the past. But tune in, make sure you watch our posts, be on the lookout for that ebook. I think you'll really enjoy that. Hopefully it'll give you a little baseline of information. So that concludes this week's episode for Watch Your Six. As I mentioned, please look us up on Spotify, Apple iTunes, YouTube channel. We enjoy all the information that we're sharing with you, and we more importantly enjoy the feedback, and we want to be here to help you grow. And we thank you for everything you do. Have a great week. Talk to you soon.